The world of trading often feels like an enigma, a realm where fortunes are made and lost, leaving many to wonder, is success on the market a stroke of innate genius, a born talent for prediction, or a skill that can be systematically learned and mastered? This fundamental question lies at the heart of one of the most legendary experiments in financial history, an experiment orchestrated by a man who became known as the Prince of the Pit, Richard Dennis. Born in Chicago in January 1949, Dennis started his journey on the trading floor at the tender age of 17, beginning as a runner, a humble start that belied the immense wealth and influence he would soon accumulate. He famously borrowed a modest sum, $1,600, though some accounts pinpointed even lower at $400 after exchange seat expenses, and transformed it into hundreds of millions of dollars within a decade, primarily by trading commodities. His extraordinary success wasn't just a personal triumph. It fueled a profound conviction that challenged conventional wisdom. Dennis firmly believed that successful trading could be taught, that it was a discipline rooted in system and logic, not merely an intuitive gift. He argued passionately against the notion that only a select few were born with the market's pulse in their veins, contending that anyone, given the right training and tools, could learn to navigate its complexities and profit consistently. This video delves into the extraordinary turtle trading experiment to answer the burning question: did Richard Dennis truly prove that anyone can get rich trading? Richard Dennis's philosophy was a direct counterpoint to the prevailing sentiment that trading success was an art, an intuitive dance with market forces that only a gifted few could master. He saw it as a science, a set of rules and probabilities that, when applied with unwavering discipline, could yield consistent results. This conviction wasn't just theoretical. It was born from his own remarkable journey. From his humble beginnings as a runner, he meticulously observed the markets, identified patterns, and developed his own robust trend-following system. His ability to turn a small loan into a vast fortune wasn't a fluke. It was the result of a disciplined, systematic approach that he refined over years. This success solidified his belief that the mechanics of profitable trading could be broken down, codified, and crucially taught to others. His argument was simple yet revolutionary. If he could distill his own trading wisdom into a set of actionable rules, then anyone who followed those rules diligently could replicate his success, at least to some degree. This belief set the stage for one of the most audacious and impactful experiments in the history of finance, designed not just to prove a point, but to fundamentally redefine how trading talent was perceived. The genesis of the turtle experiment itself was steeped in intellectual debate. It arose from a heated argument between Richard Dennis and his longtime trading partner, William Eckhart. Eckhart, while a brilliant trader in his own right, held the more traditional view that trading success was largely an innate talent, a combination of intuition, quick thinking, and a natural feel for the markets that couldn't simply be transferred. Dennis, on the other hand, staunchly maintained his position that it was a skill, a learned discipline. To settle this dispute, Dennis proposed a daring experiment. He would take a group of complete novices, people with absolutely no prior trading experience, teach them his precise trading system, and then provide them with real money to trade. The results, he believed, would unequivocally prove his point. Thus, in 1983 and 1984, the legendary recruitment drive began. Dennis placed an advertisement in the Wall Street Journal, seeking individuals to participate in a unique trading program. From a pool of thousands of applicants, he meticulously selected 23 individuals, 21 men and 2 women, based not on their financial acumen or prior market knowledge, but on their intelligence, their ability to follow rules, and their psychological stability. These carefully chosen novices were then subjected to an intensive, yet remarkably brief, 2-week training course. During this period, they were not taught fundamental analysis, nor were they encouraged to develop their own intuition. Instead, they were drilled in a purely mechanical trend-following system, a set of objective rules designed to identify and capitalize on sustained price movements across various commodity markets. The name turtles itself has an interesting origin story. It came from Dennis's visit to a turtle farm in Singapore. Observing how reliably turtles could be raised, he mused that he could grow traders just as dependably, instilling in them the necessary habits and systems to thrive. He believed that with the right environment and consistent feeding, in this case knowledge and capital, these turtles would inevitably grow into profitable traders. The core of the turtle strategy was a robust system of trend following, a philosophy centered on the idea that prices, once they start moving in a particular direction, tend to continue in that direction for a significant period. The goal was simple: to identify these large, sustained price movements early and ride them for as long as possible, capturing substantial profits. This was not about predicting market tops or bottoms, but about reacting to established trends. The system was entirely mechanical, meaning every decision, when to enter, when to exit, how much to trade, was dictated by predefined rules, removing emotional bias from the equation. Let's break down these fundamental principles and rules, which were meticulously taught to the turtles. Rules of entry: Donchian channel breakouts. The turtles primarily used Donchian channels to identify entry points. A Donchian channel is essentially a price channel created by plotting the highest high and lowest low over a specific period. The breakthrough of these channels signaled a potential new trend. Short-term system, System 1. This system was designed for faster entries and exits, aiming to capture shorter trends or the initial phase of longer trends. Buy signal. A long position was initiated when the price broke above the highest high of the previous 20 trading days. This signaled that the market was demonstrating new upward momentum, potentially starting a bullish trend. Sell signal. A short position was initiated when the price broke below the lowest low of the previous 20 trading days. This indicated new downward momentum, suggesting a bearish trend might be forming. Rule for existing positions. If a trader already had a position based on System 1 and a new signal appeared in the same direction, they would pyramid, add to the position, but only after a certain price increment. If a signal appeared in the opposite direction, they would exit the existing position and reverse. However, a crucial exception was made. If the previous entry signal was a winning trade, the next 20-day breakout in the same direction would be ignored to avoid overtrading or getting caught in whipsaws. This added a layer of discretion to prevent giving back profits too quickly. Long-term system, System 2. This system was designed to capture larger, more significant trends, holding positions for longer durations. Buy signal. A long position was initiated when the price broke above the highest high of the previous 55 trading days. This indicated a more robust and sustained upward trend. Sell signal. A short position was initiated when the price broke below the lowest low of the previous 55 trading days. This signaled a stronger, more enduring downtrend. Rule for existing positions. Similar to System 1, if a trader already held a position from System 2 and a new signal appeared in the same direction, they would pyramid. The exception here was that a 55-day breakout was never ignored, even if the previous 55-day breakout had been a winner. This reflected the system's focus on capturing large, infrequent trends. The rationale for having two systems was to diversify exposure to different trend durations and to potentially smooth out equity curves, as one system might perform better than the other depending on market conditions. Rules of exit, limiting losses and taking profits. Exiting positions was just as critical as entering them, if not more so. The turtles were taught to cut losses swiftly and let profits run. Stop losses. This was perhaps the most vital component of risk management. The turtles were instructed to exit a long position if the price broke below the 10-day low for System 1 entries, or the 20-day low for System 2 entries. Conversely, for short positions, they would exit if the price broke above the 10-day high, System 1, or 20-day high, System 2. These stop-loss points were absolute and non-negotiable. The philosophy was clear: protect capital at all costs. An initial stop-loss was always placed immediately upon entry, typically 1N, which we'll discuss next, below the entry price for a long position, or 1N above for a short position. This hard stop ensured that no single trade could incur an unmanageable loss, preventing emotional decisions from escalating a small loss into a catastrophic one. Profit-taking. While cutting losses was strict, profit-taking was more about riding the trend. The primary profit-taking mechanism for System 1 was to exit a long position if the price broke below the 10-day low, or a short position if it broke above the 10-day high. For System 2, the profit-taking exit for a long position was a break below the 20-day low, and for a short position, a break above the 20-day high. This meant that the turtles would continue to hold profitable positions as long as the trend remained intact, even if it meant giving back some unrealized gains during minor pullbacks. The discipline required to watch a significant profit diminish without taking it, trusting the system to signal the true end of the trend, was immense. This approach was designed to capture the fat tail of returns, where a few very large winning trades would more than compensate for numerous small losses. Position sizing, unit sizing. This was perhaps the most sophisticated and crucial aspect of the turtle system, directly addressing risk management and portfolio diversification. The turtles were taught to scale their positions based on the volatility of the market and the overall capital in their account. The 1% or 2% rule. A fundamental principle was to risk no more than 1%, or in some cases up to 2% for very aggressive traders, of the total account equity on any single trade. This meant that if an account had $1 million, the maximum loss on any one trade should not exceed $10,000. This rule provided a robust framework for capital preservation. Adjusting position size based on volatility using ATR. To ensure that the 1% risk rule was consistently applied across different markets and different volatility levels, the turtles used a concept called N, which was a measure of market volatility. N was calculated as the 20-day average true range, ATR. ATR calculation. ATR is a technical analysis indicator that measures market volatility by calculating the average of true ranges over a specified period, typically 14 or 20 days. The true range for a given day is the greatest of 1. The current high minus the current low, 2. The absolute value of the current high minus the previous close, or 3. The absolute value of the current low minus the previous close. Unit sizing calculation. Once N was determined, the size of a unit, the smallest block of contracts to trade, was calculated such that the price movement of 1N would result in a 1% loss or gain on the account. Unit size equals open parenthesis 1% of account equity close parenthesis slash open parenthesis N times dollars per point close parenthesis. Dollars per point is a constant for each contract, e.g., for crude oil, one tick might be $10, so a 1.00 move would be $1,000. Implication. This meant that on highly volatile markets, high N, the turtles would trade smaller unit sizes to keep their dollar risk constant. Conversely, on less volatile markets, low N, they could trade larger unit sizes. This ensured that the impact of a market moving against them by 1N was always the same percentage of their capital, regardless of the instrument. This sophisticated approach to position sizing was a cornerstone of their risk management, allowing them to trade a diversified portfolio of commodities while maintaining a consistent risk profile across all positions. Pyramiding, adding to winning positions. Unlike many retail traders who are taught to average down on losing positions, a dangerous practice, the turtles were trained to pyramid up, adding to their winning positions. This allowed them to significantly amplify their profits when a strong trend developed. Rules for pyramiding. After an initial entry, the turtles could add additional units to their position when the price moved in their favor by a certain increment, typically 0.5 N, half of the average true range from the previous entry price. Maximum position size. There was a strict limit on how many units could be added, typically up to 4 units in any single market. This prevented overconcentration and excessive risk in a single instrument. Stop-loss adjustment. Critically, as new units were added, the stop-loss for the entire position, including previous units, was moved up for long positions or down for short positions to protect profits. This ensured that even if the market reversed, the trader would still lock in some gains or minimize losses on the entire position. Pyramiding was a powerful technique that allowed the turtles to leverage their insights into trend strength, turning small initial positions into substantial profit drivers during extended market moves. Psychology and discipline. While the rules were mechanical, their execution was profoundly human. Richard Dennis emphasized that the greatest challenge wasn't understanding the system, but having the mental fortitude to stick to it through thick and thin. Emotional detachment. The system was designed to remove emotion from trading decisions. Every entry, exit, and position adjustment was predetermined. The turtles were explicitly told to follow the rules without question, regardless of their personal feelings or market noise. Consistency. Success in trend following often comes from a few very large winning trades that compensate for many small losses. This requires immense patience and the ability to endure long periods of small drawdowns or even consecutive losing trades, all while continuing to execute the system consistently. Risk tolerance. The 1% risk rule, coupled with the systematic approach, helped manage overall risk, but traders still needed the psychological resilience to accept those small, frequent losses as a natural part of the process, rather than letting them erode confidence or lead to rule breaking. This rigorous training in psychology and discipline was arguably as important as the technical rules themselves, transforming raw recruits into highly effective, rule-bound trading machines. At this juncture, as we consider the meticulous construction of the turtle strategy, its reliance on systematic rules, precise risk management, and disciplined execution, it's clear that understanding the market goes beyond just following a set of indicators. It requires a deeper comprehension of how prices move, what drives supply and demand, and how to interpret market behavior. Richard Wyckoff, another legendary figure in trading history, developed a comprehensive approach to market analysis that complements and enriches any systematic strategy. If you're looking to elevate your understanding of market dynamics and decision-making, I highly recommend exploring How I Trade and Invest in Stocks and Bonds. This adapted edition of Wyckoff's classic work provides profound insights into his methods for analyzing market structure, identifying accumulation and distribution phases, and making informed trading and investment decisions. Wyckoff's principles offer a powerful lens through which to view market action, helping you to not just follow trends, but to understand the underlying forces creating them. It's a resource that can empower you to develop a more nuanced and robust approach to your own trading. You can find a link to learn more about this invaluable book in the description below. The results of the turtle trading experiment were, by all accounts, nothing short of astonishing, and provided a resounding affirmation of Richard Dennis's hypothesis. Over the course of 4 years, the turtles collectively generated an astounding profit exceeding $175 million. Many of them doubled their trading accounts within their very first year, demonstrating the immediate and profound impact of the system they had been taught. These were not seasoned veterans, but individuals who just weeks prior had known little to nothing about trading. The experiment produced numerous success stories that continue to inspire and intrigue traders today. Curtis Faith, for instance, who was one of the youngest turtles, reportedly turned his initial $250,000 account into over $30 million. Another prominent turtle, Jerry Parker, went on to found Chesapeake Capital, a hugely successful commodity trading advisor, CTA firm, that has managed billions of dollars. These individuals and many others from the original group not only achieved remarkable financial success during the experiment, but also leveraged their training into long, prosperous careers in the financial industry becoming highly respected fund managers and traders. Their continued success beyond the immediate scope of the experiment further validated the enduring power of the principles they had learned. Ultimately, the experiment served as a powerful testament to Richard Dennis's core belief that a systematic approach combined with unwavering discipline could indeed lead to significant success in trading, irrespective of innate talent or prior experience. It shattered the myth that trading was an exclusive club for the intuitively gifted, demonstrating that it was, at its heart, a skill that could be taught, learned, and executed by a diverse group of individuals. The turtles proved that with a clear, objective system and the mental fortitude to adhere to it, ordinary people could achieve extraordinary results in the markets. However, despite the undeniable financial success of the turtles, a critical analysis reveals that the question, "Can anyone get rich?" requires a more nuanced answer. While the experiment undeniably proved that systematic trading can be taught and can be highly profitable, several factors contributed to its spectacular success that might not be easily replicable in all contexts, particularly for the average retail trader today. Favorable market conditions of the 1980s. The era in which the turtle experiment took place was markedly different from today's financial landscape. The commodity markets of the 1980s were arguably less efficient, characterized by fewer participants, slower information dissemination, and significantly less algorithmic and high-frequency trading. This environment was highly conducive to the formation of large, sustained trends, precisely what the turtle system was designed to capture. Trends tended to be longer, cleaner, and less prone to the whipsaws, rapid reversals, that are more common in today's faster, more interconnected markets. The market structure allowed for larger price movements to develop before being arbitraged away or countered by sophisticated algorithms. This meant that the turtles' trend-following signals, based on historical price breakouts, had a higher probability of leading to substantial, prolonged profits. Significant starting capital. One of the most overlooked aspects of the experiment was the substantial capital that Richard Dennis provided to his turtles. Each participant was given a trading account ranging from $250,000 to $2 million. This is an enormous advantage. Risk management. With a larger capital base, the 1% risk rule allowed for meaningful position sizes while still adhering to strict risk management. A 1% risk on $250,000 is $2,500 per trade, which allows for trading multiple contracts in many commodity markets. For a retail trader starting with, say, $5,000, a 1% risk is just $50 per trade, making it incredibly difficult to trade profitably after commissions and slippage, let alone achieve significant wealth accumulation. Diversification. Large capital also enabled the turtles to diversify their portfolios across numerous commodity markets, e.g. crude oil, gold, soybeans, currencies. This diversification smoothed out their equity curve, as losses in one market could be offset by gains in another. A small account trader often cannot afford this level of diversification, making them more vulnerable to the specific movements of a few markets. Psychological buffer. A substantial account provides a psychological buffer. Drawdowns, which are an inevitable part of trend following, are less terrifying when you know you have ample capital to weather the storm. For a small account, a series of losses can quickly wipe out a significant percentage of capital, leading to panic and abandonment of the system. Psychological aspect and discipline. While the system itself was mechanical, the human element of adhering to it was paramount and incredibly challenging. The turtle system, like most trend-following strategies, experiences many small losing trades. It's designed to capture a few very large winners that compensate for these numerous small losses. Enduring drawdowns. The turtles faced significant drawdowns during their trading careers. Watching your account drop by 20%, 30%, or even more, while knowing you must continue to execute the same system that is currently losing money, requires immense psychological strength and conviction. Most individuals, especially those new to trading, struggle profoundly with this. The temptation to abandon the system, to tweak it, or to trade emotionally becomes overwhelming. Letting profits run. Equally challenging is the discipline required to let profits run, watching unrealized gains diminish during pullbacks rather than taking them prematurely. This goes against human instinct, which often seeks immediate gratification. The system demanded patience and trust in its long-term profitability, even when short-term results were painful. The black box problem. While the turtles were taught the rules, they didn't necessarily develop an intuitive understanding of market dynamics in the same way an experienced discretionary trader might. This reliance on a black box system can be psychologically difficult during prolonged losing streaks, as there's no deeper understanding to fall back on for reassurance. Survivorship bias. When we hear about the turtle traders, we primarily hear about the hugely successful ones like Curtis Faith and Jerry Parker. This is a classic example of survivorship bias. The unheard stories. While the experiment was a success, overall, it's less clear how many of the 23 turtles continued to thrive long-term, or if some struggled more than others. The narrative tends to focus on the outliers of success. Did all 23 make millions? Probably not. Did some find it too stressful and quit? Likely. The experiment proved that the system worked, and that some individuals, given the right capital and adherence, could make it work for them. It doesn't necessarily mean that every single person who attempted it became rich or sustained that wealth. The psychological pressures alone would likely have filtered out many. Modern relevance. Despite these critical considerations, the fundamental principles of the turtle strategy remain remarkably relevant, even in today's hyper-efficient markets. Today's markets. Modern markets are undeniably faster, more interconnected, and filled with highly sophisticated algorithmic and high-frequency trading. This leads to more noise, more false breakouts, and potentially shorter, choppier trends. A direct, unadapted application of the original turtle rules, e.g., 20-day or 55-day Donchian breakouts, might lead to more frequent whipsaws and less consistent profitability than in the 1980s. Enduring principles. However, the core lessons are timeless. Trend. Following. Trends still exist even if their character has changed. Identifying and riding them remains a viable strategy. Rigorous risk management. The principles of the 1% risk rule and using volatility, ATR, to size positions are absolutely crucial for any trader in any market. This is perhaps the single most important takeaway from the experiment. Unwavering discipline. The psychological fortitude to stick to a proven system, cut losses, and let profits run is as vital today as it was then. Emotions are still the biggest enemy of the trader. Systematic approach. Having a clear, objective set of rules removes guesswork and emotional decision-making, which is a powerful advantage. Adaptations for modern markets. To apply turtle-like strategies today, adaptations are often necessary. Changing time frames. Instead of 20-day or 55-day breakouts, traders might use longer look-back periods, e.g., 100-day or 200-day channels, to filter out noise and focus on truly significant longer-term trends. This is particularly relevant in markets like cryptocurrencies, which can exhibit extremely powerful, prolonged trends. Filtering signals. Incorporating additional filters, such as volume analysis, moving average confluence, or fundamental drivers, could help confirm breakout signals and reduce false positives. Different asset classes. While the original experiment focused on commodities, trend-following principles can be applied to stocks, forex, and cryptocurrencies, each requiring specific adjustments to parameters and risk management. For example, using the 200-day Donchian channel for Bitcoin could still capture massive moves, but the end value would be significantly higher due to its extreme volatility. In conclusion, the legacy of the turtle trading experiment and the lessons imparted by Richard Dennis continue to resonate deeply within the trading community, offering invaluable insights for both aspiring and experienced traders. The primary lesson, the enduring truth that Richard Dennis powerfully demonstrated, is that success in trading is not a mystical gift bestowed upon a chosen few, nor is it dependent on innate talent or intuition. Instead, it is the direct result of disciplined adherence to a well-defined, systematically tested strategy. It is about embracing a scientific approach to the markets, where rules, probabilities, and risk management take precedence over gut feelings and emotional impulses. For contemporary traders, the turtle trading experiment serves as a powerful blueprint, even if a direct, unadapted replication of its original strategy might not be optimal in the fast-paced, algorithm-driven markets of 2025. The fundamental principles that underpinned the turtle's success remain as relevant and crucial as ever. These include mastering risk management, the meticulous approach to position sizing, exemplified by the 1% risk rule and the use of ATR, is an indispensable skill for any trader. Protecting capital is paramount, and understanding how to scale positions based on volatility is a cornerstone of sustainable trading. Cultivating unwavering discipline. The psychological battle is often the hardest one to win in trading. The turtle's ability to consistently follow their rules, cut losses without hesitation, and let winning trades run despite emotional discomfort highlights the critical role of discipline. It's about building the mental fortitude to execute your system flawlessly, especially during periods of drawdown and uncertainty. Embracing a systematic approach. Having a clear, objective trading system, whether it's trend following or another methodology, provides a framework that removes subjectivity and emotional bias. It allows for consistent decision-making and provides a basis for evaluating and improving performance. The turtle trading experiment ultimately validated the idea that trading is a learnable skill, accessible to those who are willing to put in the work, develop a robust system, and commit to disciplined execution. It's a testament to the power of structured learning over raw intuition. So, for every trader watching, the call to action is clear. Focus your energy on diligently developing and rigorously testing your own trading system. Prioritize robust risk management, making it the bedrock of your every decision. And most importantly, commit yourself to continuous learning and the unwavering, disciplined adherence to your chosen strategy. This is the true path to navigating the market successfully, a path illuminated by the legacy of Richard Dennis and his extraordinary turtles. The journey of a trader is not just about charts and numbers. It's deeply intertwined with human psychology and the timeless lessons learned from market legends. Just as the turtles grappled with the psychological demands of their system, traders throughout history have faced similar challenges. If you're looking to deepen your understanding of market psychology, the pitfalls of human emotion, and the enduring strategies of legendary traders, I highly recommend Reminiscences of a Stock Operator. This new edition of the classic work offers a profound analysis of the psychology and strategies of Jesse Livermore, one of the greatest traders of all time. It's enhanced with expert commentary and analysis for each chapter, transforming Livermore's personal experiences and insights into practical lessons that are incredibly relevant even today. It's a book that provides a unique window into the mind of a master speculator and offers invaluable guidance on managing your own emotions and developing a winning mindset. You can find a link to this essential trading classic in the description below, a resource that will undoubtedly enrich your trading wisdom.